Attendees are in listen-only mode.
Okay, I should start right now.
Yeah, Seawing.
All right, okay, here we go. Thank you very much. Hello, everyone. Thank you for attending this webinar. Easy as one, two, three. How to use your self-directed IRA, non-recourse loans on your IRA. And finally, the third topic tonight would be back-end turnkey investment opportunities. Good evening, everyone. This is Si-Wing Yi from the Yi Real Estate Network. Thanks for all of you to attend this webinar, taking time out of your important day to commit to this 1 hour tremendous powerful information. This is a very important, significant information that everyone needs to learn. The information that we are providing this evening is very few people are aware of the power of using the tools that we're going to present to you to help you create the financial future that you deserve. And once again, we have a powerful dream team of advisors here as speakers. And of course, as soon as I'm done with my quick introduction, my good partner, Tyler Watts from Networks Real Estate will do his quick introduction as well. And then my first speaker will be Lamar Baxter. He will talk about the real estate IRA, and um, and then when he's finished with his 20-minute presentation, then I have the privilege to have Jason Zook from North American Savings Bank, who's going to do a 20-minute presentation on the power of non-recourse loan to leverage the IRA, so an individual can purchase more property and what have you. And nevertheless, this is a tremendous information. And without further ado, and let's get going. And Tyler, go ahead and say what you have to say. Then we'll get it going.
All right. So yeah, I just wanted to thank you, Seawing, for putting this together. Uh, have also here at Net Worth Real Estate, we've also enjoyed getting to know Lamar and Baxter and Jason Zook in their roles with what they do in their different businesses there, and we should certainly appreciate the efforts and everything that they've put in. So we're glad to have them on board here for the webinar tonight. And yeah, I'm excited to hear what they have to share tonight and see what we can do to help everybody build and grow a richer and more plentiful retirement. So excited to be here. Um, I think Lamar was going to start out, Seawing.
Right.
So Lamar, if you're ready, go ahead and let's introduce you. And can you introduce yourself and what it is you do, and we can go from there.
Okay. Hello, everyone. My name is Lamar Baxter. I'm the Business Development Manager for Director of Business Development for AccuPlan Benefit Services. My role is to both educate as well as to assist my clients with structuring their retirement plan, whether it be a self-directed IRA or 401k, and advise them of the many options that's available to invest in real estate and a lot of other alternative investments. Today's topic, we're going to focus primarily on real estate, being that is one of the hottest asset classes out there used as it relates to the self-directed plan. But we're going to talk about, in addition to the different plans or the options and structures available using a self-directed IRA, we'll also talk about the rules that one must follow to make sure that the retirement plan remains compliant. Just to give you background on myself, I have over 27 years of varied financial experience. Within that 27 years, I also would include 13 years of real estate mortgage, as well as real estate sales, uh, accounts receivables factoring, and various other aspects of commercial banking and other types of consumer banking. In addition to myself being a financial professional, I'm also an investor. In the past, I've also invested in real estate. My current investments primarily are in actual secured notes or deed of trust, where I'm actually loaning monies from my self-directed IRA against deeds of trust or for properties where the actual collateral is the real estate property. So unlike maybe some of your other planners and advisors, I'm actually practicing what I preach. Just kind of give you a quick disclaimer here, because once again, our objective is to educate you and kind of give you an idea of what power you have using this retirement plan. Just going to read our quick disclaimer here. AccuPlan Benefit Services and its affiliates do not provide any investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering in any type of investment. So it's really important that any information that you do not possess personally, you want to definitely assemble that team of both tax and legal professionals to help you along the way. So just a little bit about AccuPlan. We're a national company. Our role is both an administrator as well as a custodian. So we're broken up to two parts. AccuPlan provides the administrative aspect of the responsibilities for maintaining your retirement account, and American Estate and Trust, which is our parent company, is the custodian. We provide self-directed IRA and 401k administration products and services to individuals looking to invest in their retirement accounts and basically take advantage of the non-traditional investment structures that's out there. We have a very expansive team that basically makes sure that once again, your transactions are compliant, and we're passing along relevant and updated information as it relates to IRS code and Department of Labor rules and regulations to make sure that your plan and your investment structure remains compliant. We maintain an expert staff consisting of both tax, legal, and IRA professionals, as well as other administrative roles that we will take on as well to make sure that your transactions and your accounts remain compliant. Just before we get started, one of the things I like to talk about is just why are most people considering a self-directed plan. I'm just going to go down this quick list of bullets here, just kind of give you an idea why a self-directed plan. Why are most clients taking a proactive approach in terms of looking outside of traditional realms of investing and looking at alternative investments and able to use a self-directed IRA or 401k to grow their retirement account. It's estimated over 10,000 baby boomers per day will turn 65 for the next 20 years. And of that segment of the population, 75% of the baby boomers are not in a position to retire beyond the age of 65. Most will be forced to continue to work after the age of 65, provided that their employer or depending on their occupation, that they're allowed to work beyond the age of 65. Retirees will face skyrocketing health care costs and diminished Social Security benefits, as well as Medicare benefits. So a lot of the benefits that previous generations have taken advantage of to depend on as part of their retirement package is probably not going to be there. So it's really important that you take a proactive approach and start really looking at every aspect of an investment that's out there. Really educate yourself in terms of what's out there and basically put yourself in a position to control your funds, because no one else is going to do it better than you can do it. In addition to the others I just mentioned, inflation and cost of living will threaten to erode your fixed income. So you got to factor in the cost of living is constantly rising. A lot of us are sometimes going to be forced to maybe take care of children, grandchildren, and sometimes even our parents. So you get looking at your fixed nest egg. Is it going to be enough to carry you through retirement? So once again, looking at the self-directed plan and as many investment options is definitely an option to basically put you ahead of the game to take control of this. It's estimated at $4.7 trillion in combined IRA and 401k funds are out there, and that's just pretty much 401k and IRA. It's not I'm not going to say it's going to be consist of some of your other plans, such as your hold on just a moment here. It's not going to be also consisting of some of your 403bs, some of your other 457 plans. This is just IRA and 401k plans, and of that $4.7 trillion, only 1% is actually invested in alternative or self-directed plans. So we're definitely going to have to do something about changing that to make sure that we have the option to educate the public in terms of what power they have using this plan. It is estimated up to 90% of the population is unaware of what a self-directed plan is and how it works. As part of the ERISA Act that was passed in 1974 by Congress, it allowed most custodians to be able to offer a plan agreement that will allow retirees, or say the retirement account holders, to be able to invest in alternative investment classes, and that would also include real estate. We'll talk about some of the restricted asset classes that you're not allowed to invest in, but once again, that list is a lot longer as it relates to what you can invest in, maybe opposed to some of your traditional investments. Of that 90% of the population, that would also include your attorney and maybe your accountant, who are not specialists or maybe not really educated in this area of the tax code, which is IRS Code 4975, but most of these professionals are beginning to come up to speed because the self-directed plan is gaining popularity. Your financial planner, once again, wasn't trained in this aspect of the tax code, nor does their plan agreement allow some of the alternative investments, so that's not going to be an option available to you through your current retirement plan if it's not truly self-directed. Your current custodian may offer a self-directed plan, but the question is it a truly self-directed plan? And the question usually is going to be, are you able to invest in both traditional and non-traditional asset classes? If the answer is no, you more than likely do not have a traditional or say a truly self-directed retirement plan. And that's where you would need to move it over to a custodian like Accuplan in order to allow you to have those options available to you to take advantage of alternative investment vehicles. Diversification is the key, whether it be alternative investments nor traditional investments. It's really important that you have a very diverse investment portfolio. As I mentioned earlier, $4.7 trillion in IRA assets, most invested in Wall Street, and that would be some of your stocks, your bonds, your mutual funds, CDs, and so on and so forth. And it's okay to continue to invest in those areas, but you also want to make sure that you widen your grasp in terms of making sure that you have a really diverse investment portfolio that consists of also your traditional as well as your non-traditional asset, or what we call alternative asset classes. Majority of those funds are invested in mutual funds and brokerage firms, as I just mentioned. And as I mentioned in a previous slide, less than 1% is invested in alternative asset classes. Our model in the self-directed IRA industry is to invest in what you know and understand. We like to believe that the majority of the population have a knack or an ability to be able to go out and search out great investment opportunities, provided they have the right education and or the right team in place to aid them in that task. Here are some of the 4 top investment classes that I have seen come across my desk this 5 or 6 years. Going on 6 years I've been in this industry. Real estate, as I mentioned, is the #1 asset class. Real estate would also encompass both residential and commercial, land, as well as commercial, should I say international real estate, and also what we consider real estate related transactions such as loans secured by real estate. Precious metals is another investment asset that's available to you, or investment class that's available to you. It's something that was popular up until 2010, but as a result of the market changing and the economy changing, that's kind of one of those situations where that market, or should I say that area, has kind of hit a plateau. But once again, using a self-directed plan, that option is available to you. I just mentioned that private notes and loans, or loans secured by real estate, is an option. That is one of the #1, or I should say one of the growing asset classes as it relates to the asset class related to using a self-directed plan related to real estate that's growing. So for those who want to take more of a passive approach to investing in real estate, you have the option to become the bank. What that means is that you can take your self-directed plan and actually become the bank, loaning money to an individual or to an organization secured by real estate, where you become the lien holder, or should I say your retirement plan become a lien holder on that property as collateral for the loan that's granted. Private companies, there's a lot of startup companies as well as existing business that are starving for cash right now as well as capital. So it's important that you're aware that you can use your retirement plan to also invest in new or existing businesses. Here's some list of some of the, I would say, transactions that I've seen within the period of time that I've been in the industry. And I'm sure if you look at this list and you contact either your planner advisor or even some of your other financial professionals, in particular your custodian where your plan is currently located if you do not have a self-directed plan, and ask them if this is an option for you to invest your current portfolio, I'm sure the answer would be no. Just looking at this list should really open your eyes in terms of what type of latitude you have in terms of growing your retirement account and some of the investment options and structures that's available to you. Prohibited transaction, as I mentioned, there are certain rules that must be followed in order to make sure that your plan remains compliant and that you don't suffer any form of taxation and or penalties prior to the time you start taking distributions prior to your retirement age. So just kind of give you an idea or summary how it works is an IRA cannot engage in any transaction directly or indirectly with anyone or anything considering related to the IRA. Some examples of a prohibited transaction would be, for example, selling or exchanging or leasing property, lending money, or extending credit to any disqualified person. And we're going to talk about who's considered a disqualified person on the next slide. It's really important to understand who you can and cannot do business with, because that can make or break your deal. As I mentioned earlier, it's important to have your team in place as well as to do any education, to furnish yourself with education as well as the resources that you need to put your transactions together. And that's one of the things that make myself available to be able to answer any questions you have, as well as to talk to any of your professionals as you structure your transactions. So as we mentioned, disqualified persons are parties you cannot do business with. So for example, you're not able to do business with yourself, your spouse, parent, grandparent, children, or grandchildren. That would also include any lineal ascendants as well as any lineal descendants, including their spouses. That would also include any fiduciary to the IRA. Anyone who's serving in a fiduciary capacity representing you or your IRA would not be allowed to partner with you on that particular transaction. Anyone providing services to your IRA, and that would be myself included, would be also considered a disqualified party in terms of being able to partner with you or your IRA in any transaction. One of the common questions that come up is for those who are involved in a business or have a business where they're looking to obtain additional capital. They want to know if they can use retirement funds to fund or infuse capital into that business. And the answer is yes and no, and it really depends upon ownership and percentage of ownership. So in this case here, corporations, partnerships, trusts, or estates in which you own directly or indirectly less than 50%, the answer is yes, you can actually invest. So you don't want to have any controlling interest in that organization. And when we say 50%, that would also include you and a spouse. So it couldn't be a situation where you're claiming 49% and your spouse is claiming the other 51%. The 50% threshold would be consistent upon, will also include both your ownership as well as your spouse's ownership rights within that organization to determine whether it's a prohibited transaction or not. Prohibited transaction example, one of the more common examples or examples I'm going to share with you in terms of what a lot of clients make the mistake of is establishing or going in a contract, in particular with real estate, going in a contract whereas the client can't wait to open up the account. They ran across a deal of the lifetime over the weekend, and they enter in the contract under their name, assuming that they can change the contract over from their name to the IRA. As I mentioned, you cannot do business with yourself or you cannot do business with the IRA. So in the eyes of the IRS, if you go into contract under your name and switch it via an addendum to the IRA, in most cases, that contract, whether you put a value on it or not, is considered deemed as a valuable piece of a valuable transaction, whether you put a dollar amount on it or not. So anytime we in compliance see a transaction where there's any reference to where you own the property or any other disqualified person owned the property prior to transferring the property to the IRA or 401k, it will be deemed a prohibited transaction, and we will actually cancel the transaction. So the rule is to make sure that you establish the account first, obtain your legal IRA vesting or 401k vesting. That will allow you to go into contract under that entity or that structure of that name. In this case, it would be an IRA or 401k. And once that account is established, you're going to be assigned a legal vesting. That legal vesting will be on all of your documentation, deed of trust, everything included. So it's important to make sure that an account is established. That also makes sure once you get the account established that you have adequate funds to take care of the security deposit. This particular slide basically shows where a client had used personal funds to take care of the security deposit, or I should say the escrow deposit, assuming that before the transaction was to close, if they was to take the monies out, that it would be okay. In this case here, it shows that even though the monies was taken out before everything was to close, the escrow company still documented that the deposit was made, and that was a red flag, and we had to kill the transaction. At least for the time being, we had to kill it, but what we ended up doing is closing out that escrow account, generating a new HUD-1, which reflected only funds from the IRA to take care of the escrow deposit, and we was able to remedy the problem. But you're not going to always have the ability to go through a title company who's willing to reverse this and start the transaction all over again. So make sure that you follow the instructions and consult with your self-directed IRA custodian in terms of what the rules are and what you should and shouldn't be doing. So in summary, do not mess with the IRS. You definitely want to follow the rules, and if any of you have any questions as it relates to what those rules are, it can be pretty expansive. I do have a quick read PDF that I can send out to any clients who are looking to understand the rules, and it's important to maybe have those to reference as you're putting together and structuring your transaction, because that's key in terms of trying to make sure everything is done prior to finding out the last minute something's wrong. So how do you actually put funds into your account? We call it putting gas into the tank. So you have 4 different methods of actually contributing or adding funds to your retirement account. The most common transfer, or should I say the most common method of funding your account, would be a transfer, and that would usually consist of moving funds from one IRA to another IRA, in this case being a self-directed IRA. It is a non-taxable event because monies are not dispersed to you personally. The funds are usually transferred directly from your existing custodian over to us, usually within 7 to 10 business days. The other option would be a rollover, and that can be used both for an IRA or for a 401k. In most cases, the rollover is usually associated with moving funds from an employer-sponsored plan such as a 401k over to your new self-directed plan. And the process could be either direct rollover or an indirect rollover. The direct rollover is where they would actually send the funds directly to us as the custodian. An indirect rollover would be where they would send the funds directly to you, in which you would have 60 days to get those funds over to the new custodian or the new account to avoid a taxable event. In both cases, the 60-day clock starts to run as soon as the check is cut. So it's really important to track the check as it's being mailed from the existing custodian over to the new custodian to make sure those funds are received, because there is no grace period as it relates to when those funds arrive. It's 61 days, no exceptions. There will be a taxable event as well as a possible early distribution penalty if you're under the age of 59 and a half. A contribution is going to be relative to what type of plan that you choose and you're eligible for, and we'll talk about what contribution limits that that's available to you depending on what plan you choose and or you're eligible for. The other is a conversion. That would be consist of moving funds from a tax-deferred account such as a traditional IRA, a SEP IRA, or 401k over to a Roth IRA. And the objective there is to pay the taxes now and grow your retirement to where after you've met the 2 milestones of 5 years that you've had the account, the Roth account, and you're 59 and a half, all growth is tax-free when you start to pull the funds out. So that's something that's gaining a lot of attention and popularity as it relates to no one knowing where the tax structure is going to be in the next 5, 10, or 15 years. So these are your different types of plans. If you look at this list here, I'm sure based on maybe what you have currently or what you've probably seen with some of your other custodians, these are your same plans that you would have at other custodians. As I mentioned in the beginning of the presentation, the difference between our plan as well as in conjunction or in comparison to some of your plans with your other custodians is that our plan agreement allows you to invest in alternative assets. So the same contribution limits you have with your current plan, if this would be the case for you, would be the same applicable rules you would follow as to relates to contribution limits into the new plan. So real quickly here, you have the traditional IRA that allows you to contribute up to $5,500. And keep in mind, I'm emphasizing up to because there is a required, or should I say a modified adjusted gross income threshold that you have to adhere to make sure that you're making the adequate amount of contributions each year. And that could change every year, so it's really important every tax year that you consult with your tax professional to figure out what is your modified adjusted gross income to make sure that you're making both the maximum contribution that's allowable to you and that you're also not making an excess contribution, because there is a 6% penalty for making an excess contribution over and beyond what you're allowed. The Roth IRA, same contribution limit, up to $5,500, and you notice both have an asterisk. And what that means is that there is a $1,000 catch-up and an additional $1,000 you can add to the account if you're over the age of 50. So if you're over the age of 50, $5,500 plus the additional $1,000 gives you $6,500 each year that you have available to you to make a contribution into that plan, provided that you're eligible to make the maximum to the contribution to the plan. SEP IRA is for those who are self-employed or 1099 employed. You're able to make a contribution, a tax-deferred contribution that is up to $52,000. Once again, this allows those who are self-employed or 1099 to make a much larger contribution than those who maybe have a traditional or Roth. And in most cases, those with a traditional Roth are usually those who are W-2 employees, or at least they're limited to just those with the W-2 employees. But those who are self-employed also can go with the traditional and Roth. But as it relates to the SEP and some of the other plans, is usually for those who are 1099 or self-employed. The simple IRA also is a form of an employer-sponsored plan. It's usually for those employers who have 100 employees or less. Each employee is able to make up to $12,000 a contribution into the plan. Once again, it's also a tax-deferred plan as well. The 1K is one of the more popular plans that's kind of gaining some steam and momentum in the industry. It has pretty much the equivalent or close to the equivalent of a contribution of the SEP IRA. However, you have two components. You're able to, as long as you're 1099 or self-employed, you're able to contribute to this plan as both the employee as well as the employer. If you look down here below, it shows what the employee versus the employer contribution is up to $51,000. And if you're looking to also add, and it's not listed on the screen here, but if you also want to take advantage of making one of the buckets a Roth bucket, you also have the option to convert that bucket into a Roth, to where, once again, after 5 years and 59 and a half, you can pull out any funds within that Roth bucket within the Solo K tax-free. So if you have any questions on that, feel free to give me a call, and I have my contact information up towards the end. So before we wrap up here, we're going to talk about just some of your partnering options. I know when I work with a lot of the partners that are going to be on this call today, I see a variation of structures in terms of partnering and wanting to know what their options are. Partnering being an LLC for small or large groups is definitely an option, but there's certain rules that must be followed to make sure that if there's any disqualified parties within the group, that there's certain percentage of ownerships that needs to be listed, and that those rules must be followed throughout the transaction. For more information, give me a call, and I can also send you over some rules via PDF in terms of what those rules would be partnering via an LLC. Partnering via tenants in common. This is another inexpensive way of partnering without having to go through an LLC. And most, I would say all should be the case. All real estate agents who are licensed should know how to draw up a tenants in common structured purchase contract. And what's important there, if there's an IRA involved, even with personal funds, it's important that the percentage of ownership for the IRA is relative to the amount that's going to be contributed towards the acquisition by the IRA or 401k, and that has to be listed in terms of percentage of ownership on the purchase contract or in the vesting as it's listed on the purchase contract. Non-recourse loans, I'm going to leave that information for Mr. Jason Zook of North American Savings Bank to take care of, but that is a critical part of the transactions that are coming across my desk in terms of structuring. A lot of clients are looking at the value of leveraging using a non-recourse loan in conjunction with their IRA to buy either more properties, as well as to kind of give them a little more flexibility using leverage, and that's something that's really gaining a lot of steam as well. New deal exception, partnering with yourself and other disqualified persons. As I mentioned earlier, is usually something that's prohibited. And what the new deal exception means is that anytime a disqualified person wants to partner with the IRA, provided the IRA nor the actual disqualified person, say in this case here is the IRA holder, does not have any existing or previous ownership in the property, they can actually partner with themselves using their private funds in conjunction with their IRA, maybe a spouse's IRA, to be able to go into partnership. But there are certain rules that must be followed at the beginning as well as throughout the transaction and the end of the transaction to make sure everything stays compliant. For more information, definitely give me a call, and I'll have, once again, some rules that you can actually follow in terms of structuring it. And I've done several of these also with the group that we're going to be talking about hopefully in the near future, but there's something that's picking up a lot of steam as well. A lot of people are not aware that there's a variation of structures that's available, provided that you follow the rules. So the objective here, once again, is to get that plan established. So here's the checklist that is required in order to get started, which consists of establishing an account, funding the account, and basically making your investments. So first step was definitely, as I mentioned, establish your account. Get your funds into the account, whether it be via transfer, rollover, or contribution, or a combination of all. Complete your direction of investment and other forms, which are internal forms. Usually what we'll do on that to make everything real simple is we work pretty close as a team. So what happens is these forms usually are completed by our internal staff based on the information we receive in the form of a purchase contract. And it's just a matter of getting everything over to you as the account holder for you to review it and make sure everything's in order, sign and get it back to us. And from there, it's pretty much a normal transaction. You'll be in communication with everyone involved, and it's not as cumbersome as some may lead you to believe, or maybe depending on your experience with other groups. We work pretty close together to make sure that this is as seamless as possible for you. So once everything is ready to go, we complete the purchase contract, provided and executed purchase contract, and we just wait for the title and escrow instructions for its closing documents, and depending on the timeline, we can close almost immediately. In most cases, from the time we receive a complete purchase contract as well as all the closing documents, so we can usually close within 3 business days from the receipt of the entire packet. So it can go pretty quickly. So a lot of times, depending on how long it takes to fund your account, and if you're maybe having a property built, it could take longer. But in terms of getting everything ready to go, it's usually 3 business days for us. So here's a flow chart that basically gives you an idea of what the process looks like. I know some people are visual, so this is a real good visual aid to give you an idea of what the process looks like from beginning to end. Step one, once again, will be opening the account. And opening the account, we can send you over the application via PDF, or we actually have a quick link that you can go online and actually complete the application within about 3 to 5 minutes. Pretty self-explanatory. Just follow the prompts, and instantly you will receive an account number. The only thing we would require is that you send us over via email a scanned copy of your government issue ID. Could be a driver's license, identification card, or a passport, and within 24 hours or even the same day, your account's ready to go. We'll issue a legal vesting. That information is usually forwarded over to your real estate agent to enter that information on your purchase contract, and everything starts from there. While we're waiting for your funds to roll over, like I said, we're usually getting all your paperwork ready to go, and by the time the funds arrive, in most cases, depending on the structure or the timeline of the transaction, we can once again get everything ready to go within a matter of a week and a half tops from getting the account established and funded and getting everything signed and closed and funded. So this is pretty much my presentation for the evening. I'm going to go ahead and pass this information over just real quick here. I'm just going to run over the quick summaries here. IRAs can hold all types of investments, not just securities. So despite what you're being told by your planner advisor, you can hold alternative investments. Do your research, and make sure that whoever you partner with is a knowledgeable party when it comes to assisting you with your transaction. Partnerships and split ownerships are allowed. We talked briefly about some of your partnership options. If you want more information on that, feel free to give me a call. IRAs and solo K plans grow tax-deferred or tax-free. So depending on what your objectives are, you want to give me a call, and we can talk about it briefly, and then if necessary, bring your tax professional in, determine which is going to be best for you, both short-term and long-term, as of whether you want to start to grow your retirement tax-free or tax-deferred. All plans qualify for partial transfers and conversions. And that's something that's really important, because for those who want to convert from a tax-deferred account to a tax-free account, such as the Roth, you're not required to do a full conversion. So if you want to take a portion of your tax-deferred account and slowly but surely move those funds over and take the tax hits on an annual basis as in little chunks, so to speak, that is an option that's available to you, but that's something you definitely want to check with your tax professional to see where it's going to put you each year in terms of what your tax liability is going to be by adding that additional income to your to what you're going to be paying out to the IRS. Be sure to establish and fund your account prior to entering the contract. I can't emphasize that more. So with that being said, that's it for me. This is my contact information. If you have any questions, feel free to give me a call, send me an email. I'm also active on your some of your social media platforms, Twitter, Facebook, and LinkedIn. Feel free to check me out there in terms of a lot of information I share as it relates to current events relative to real estate investing and retirement planning that I think you would find pretty interesting. So I'll go ahead and turn this over to our next speaker. And I'd like to thank everyone for coming out this evening, and I look forward to talking to you in the future. Thank you.
Thank you, Lamar. Jason, I'm going to go ahead and allow you to start sharing your screen now and change that over to you, and go ahead and introduce yourself and let us know a little bit about what you can help with, okay?
Definitely, that sounds good. And as soon as I
Here
get
you
that
go.
screen up. All right. And can you see the screen?
Yeah.
Great, great.
You just change it to the slideshow.
All right, there we go.
Yep.
Thank you to the other to the organizers and panelists for having me here, and especially Lamar with that great presentation on where to go to set up that self-directed account. We are North American Savings Bank, and also called NASB. We're here to help you leverage the retirement account in case you'd like to leverage it. The advantages of using debt financing. We're going to go over the advantages of using the debt financing, how you can get a non-recourse loan to buy real estate in the IRA, and also the guidelines and parameters for an IRA non-recourse loan through North American Savings Bank. I'm Jason Zook. I've been doing this for about 10 years now, and I'll keep it short for you here because a lot of you are going to want to know some of the basics as far as loan to values, interest rates, closing costs, and I can give you some of that information offline as well. Some of the reasons for getting the non-recourse loan are you don't have enough money to buy that property that you're interested in, or maybe you want to buy multiple properties. We can help you with a residential home through that self-directed retirement account, and we'll go over some of those terms associated with it. First, we'll talk about what the non-recourse loan is. Basically, it's a loan that you are not personally liable for. Your IRA is going to be responsible for paying it back, and so there's no recourse against you or the IRA, only the property itself. So it makes it very easy for you personally. We're not checking your income, your assets, your employment. We're just really strictly looking at the property to qualify for this loan. So there's not a lot of paperwork involved for a normal traditional loan that you've seen. And in the event of default or foreclosure, we can only take the property. It doesn't happen very often. Most of the times you're putting down 30 to 40%. So for the chance of you letting the property go from that is not very likely. Publication 590 states that you cannot use the IRA as security for a loan. This only leaves one option, and most banks don't offer this type of loan. We actually started it about 10 years ago. We wrote the book on it, and if you'd like a free copy of this book, feel free to contact me after the seminar or some other time, and I'll be happy to send a copy over to you. We're North American Savings Bank. We've been around since 1927. We're out of Kansas City, Missouri, and we offer a wide variety of loan products. We have $1.5 billion in assets, publicly traded under the NASDAQ, so you can do your own research on us to make sure that we're legit as well. Some of the advantages of using debt financing within a self-directed IRA are that all the proceeds go back into the IRA, tax-free. You can leverage your IRA this way for larger gains in your retirement account by not having those taxes that you're used to. We focus on residential real estate. If you're buying, say, a single-family home, townhome, condo, multi-unit, we can help with any type of residential. So who is eligible for a non-recourse loan? Well, usually anybody who has at least 30 to 40% of the purchase price vested in the IRA account can use a non-recourse loan. We do typically want to see some reserves as well, although those reserves can be shown in any retirement account. You're not required to move all of the funds over to that specific self-directed account in order to purchase the property. On single-family homes, we typically want to see about 30 to 40% down, depending on the property itself. We're going to look at its curb appeal, its expected cash flow, and also the reserves available in your retirement account to service the debt. On all other types of property, we do typically require at least 40% down, but as mentioned, on the single-family homes, there is a chance to go above that above the 60% loan, and possibly even up to 70% if the property warrants it. This is not a multifamily, but you probably already know that. I'm sure you don't see many of these around. And as Lamar talked about earlier, the vesting requirements on the contract are going to be very specific, and Lamar can help you with that as well. Typically, it'll be the American Estate Trust or AccuPlan can help you with the exact vesting requirements of that. If you're not getting a non-recourse loan through us, it may be a little different where you can use account numbers, but make sure and talk to Lamar or myself about that before you enter into that contract. As I mentioned, we can finance properties in all 50 states and have done so. Typically, most states will qualify for at least 60% and some as much as 70%, as previously mentioned. Once you have a property in mind, I can take a look at it and usually get a decision for you within a day or so. If you decide to proceed, we will then collect the money for the appraisal. That's the only money that we'll collect up front. And it does take about 30 to 35 days to close from this point. After we are ready to close the loan, we will have to send the documents over to your title company. You'll then perform a read and approve on those to make sure you agree with them, and then they'll be overnighted to Lamar at AccuPlan to make sure he agrees with all of the loan documents to make sure they're all in compliance. After they are executed over there, they are shipped back over to the title company, and the loan will then fund. So there is a little bit of lag time between you actually signing the documents and the time it funds, usually just a couple of days for something like that. So the loan types that are available through North American Savings Bank, we do have a collection of ARM products, which stands for adjustable rate mortgage, and some fixed loan products as well. Now the ARMs are fixed for 3 years, 5 years, or 10 years, and then adjust annually after that. Typically the loan interest rates right now are as low as they've ever been. You can get a 3 or a 5 year ARM down in the 4s and as low as 4.25%. And a 10-year ARM is in the 5s. It's at 5.5% right now. Once the adjustable rate period is over, it would adjust based upon the 1-year Treasury bill and our margin of 4%. The 1-year Treasury bill is at a historic low. I believe it's been under 1% for quite a period of time now. So you can see that the rates are historically low, and we hope to be able to maintain those there. You can also get something that's fixed for the entire duration of the loan. 10 years, 15, or 20 years are the options that we have. And these start in the middle 5s and go up to the highest interest rate we offer is 6.25%, and that's for a 20-year fixed option. So the interest rates are anywhere from 4.25% all the way up to 6.25% with a wide range in between there. We do have a minimum loan size of $50,000. Because we require at least 30 to 40% down, you can see this will make your minimum purchase price anywhere from about low 70s up to about mid 80s, depending on the type of property. We do also allow for you to do a cash out refinance. What that means is if you are under some time restrictions and you have enough money in the account to purchase the property, you can do so and then come back to us. And we can also repeat that same loan process where it takes about 30 to 35 days, and we just then deposit the money back into your retirement account. All the interest rates and fees are the exact same whether you do a purchase or cash out, unless you have held the property for a longer period of time. Then sometimes the origination fee is increased, but if you talk to me, I can see if we can get that waived. The properties that are eligible, as I mentioned, are residential, the single family, warrantable condos, PUDs and townhomes, duplexes, fourplexes, multifamilies. We do normally concentrate on 1 to 4 units, and we'll go greater than 4 on a case-by-case basis, and I've seen us go all the way up to 12. Now, one thing about this loan product is we do not sell this to other financial institutions like most banks do. Because of that, it does give us some leeway to do things that other banks cannot. For instance, on the condos, if it's not warrantable because let's say that there's a lot of investment units compared to owner-occupied, there's a good chance we can still get that through. We'll just have to take a look at it, and then we'll try to be common sense about it and make sure that it makes sense for us and you. Some of the ineligible properties for our non-recourse loans are residentials with really large acreage. Typically anything over 3 acres, I will have to get an exception on, but we have done plenty of those. We just don't like to lend in an area that maybe is unincorporated or there's nobody around. But raw land, farms, manufactured or log homes, as I mentioned, the non-warrantable condos, although we can get exceptions for that. And then most types of commercial property like hotels, condotels, co-ops, entertainment and non-franchised restaurants, mini storage. So once again, it is just more on a residential level for our non-recourse loans. And as Lamar talked about, you can own these properties in a self-directed IRA, LLC, solo K, also a C Corp or a partnership, and I'll let you talk to Lamar about that for the specifics. All right, so the income requirements for the rental property. Typically, we want to see that the property can sustain itself as a rental property. So we're going to ask you up front what you believe it could obtain in rental income, and then we also have the appraiser perform market rents on the report as well. We do want to see that it can cash flow normally by about 20% on a single family home and 25% on all other types of residential. However, if you're wanting to do say a 10-year fixed loan or a 15-year fixed, we do understand it may not cash flow always where it meets these guidelines, and we can give exceptions for that because you are paying the loan off quicker on that shorter amortization period. This is what we're looking for and probably what you are for the most part anyway. A little bit newer single-family home. It can be attached, though, with a townhome or a condo or a multi-unit, but something that just has good curb appeal that you would want to live in if it was yours as well. So we'll go over some of the figures quick as far as how to get to that debt service coverage. The DSCR, which is debt service coverage ratio, we'll go over a home, let's say in the Bakken area, that has a purchase price of $254,000. Say this property is receiving $3,500 in rents. If you annualize those rents, that equals a gross income of $42,000 a year. The items that we will subtract from this to help in our analysis are expected vacancy per year, which we put as 7% of those gross adjusted income, your taxes, your insurance, maintenance per year, and then also a management fee that you may have to pay a property manager. This is not something you'll pay to us. We just use it in our cash flow analysis to see where that debt service coverage ratio will land. So after you subtract these items out, you can see that your net operating income would be $32,395. We then figure in the mortgage payment on a $152,400 loan, which is 60% of that $254,000 purchase price, and you can see that subtracted out, your debt service coverage ratio is still at 2.81. To give you a reference point, a 1.0 is break even. A 1.2 is where we require it. So a 2.81 is definitely huge positive cash flow for you. That net operating income of $32,395 divided by your principal and interest payment of $11,694 leaves you quite a bit of cash flow back to the retirement account each year. Some of the fees that you'll pay for doing this type of loan, we charge a 1% bank origination fee based upon your loan amount, and then $695 total in processing and underwriting fees. Beyond that, you'll have a small flood certification fee to see if it's in a flood zone or not, and then an appraisal. The appraisal fee is dependent on where the property is located. Each state has a different amount of fees, and some states or some different rural areas, if there's a lack of appraisers, we may have to get a special quote, and I can help you with that as well. At the bottom, you'll see as on the asterisk, we do require an impound for taxes and insurance. We are responsible for paying these, so if you would leave the property for any reason, we're still going to be on the hook for those taxes, so that's why we do require the impounds on that. The documentation required for the loan approval, as I mentioned, it is not your income, your assets, your employment. Basically just a real simple loan application, a copy of your retirement account statement, the purchase contract, the appraisal that we will order, a copy of your driver's license, and then any other documentation that you would need from Lamar and AccuPlan. They may have a direction of investment letter that you'll have to complete, and then we'll also have to get your insurance put into the AccuPlan's name as well. Now, for the end of our presentation, I just want to let you know that we are at IRAlending.com. We have a podcast there, as well as my email address is there. If you'd like more information, I can send over that DSCR worksheet, a loan application, an eligibility form if you'd like us to take a look at a property and run some numbers with you. I'm happy to do so at any time. And here's the number that we can be reached at, as well as that website again, and what the book looks like. If you'd like a copy of that, once again, just shoot me an email. I am at jzook@nasb.com. That's JZOOK at nasb.com, or you can look me up at IRAlending.com. Thank you for your time.
Thank you, Jason, and appreciate that presentation. Really appreciate the fact that you had a picture of a bunch of mobile homes stacked on top of each other there.
I'm not sure where they got that, but that was interesting.
One second, folks. I need to pull this back up. I just closed it on accident. All right. So, yeah, again, appreciate that, Jason. And I also appreciated the example that you used there for the purchase price of the property there, which is exactly one of the units that we deal with here in North Dakota. I think that's where you got your numbers, if I'm not mistaken. Does that sound right?
That is correct. It is.
Well, thank you for showing that, and thank you for explaining the fact that it is a great investment when it comes to the cash flow that it does generate. So, my name's Tyler Watts. I'm with Net Worth Real Estate Group, and part of what we talk about quite a bit here is the opportunities in North Dakota. We have opportunities all over the country that we deal with, but one of the main focuses that we've been focusing on over the last year or so is primarily North Dakota because of the oil patch and the situation that's going on here. Little brief explanation as to who we are and what we do. We like to say that we are the piece that kind of bonds the the bridge there together from education to implementation when it comes to real estate investing. There's a lot of people out there spending a lot of money in education that never do anything to implement that in their lives. I've invested or I've sponsored Rich Dad Poor Dad events that are very, very expensive, and I've seen a lot of investors, hundreds, if not thousands of investors go through the program that have invested, $10 to $70,000 in real estate education and still don't own a property yet for an investment property. So we like to bridge that gap and kind of bond the two together and make sure that the opportunity for implementation is there for any investor that wants to be a part of it. Depending on what you want to do and what your capabilities are, we can actually service those needs. So we were established in 2002. It's a nationwide investment real estate brokerage. More than 5,000 properties sold, over 100 years of combined experience. And with C-Wing and Lamar now and Jason, man, we've got well over 100 years of experience now. So thank you guys for joining that club. We've shared our expertise with over 15,000 clients, and it's probably going over 16,000 clients now over the last year and a half that's been growing. So the richest people, there's a famous quote by Robert Kiyosaki: the richest people in the world look for and build networks. Everyone else looks for work. So we like to build networks. We like to get together, and that's why we're here with the webinar with a group of great people that can really help any individual put to use their financial means to grow and expand and be a bigger part of what's going on out there to build their own personal net worth. So what sets North Dakota apart? Truly, it's the oil patch. It's what's going on with the big oil boom up in North Dakota. The housing and the demand for housing is just going crazy due to the finds of oil that they have found. There's 3 different layers of oil. What you're seeing here is the Bakken Shale layer, and then the Williston Basin layer as well. And there's one in the middle of those called the Three Forks layer. That these are all sweet crude, except when you get to the Williston Basin, which is traditional kind of find for oil. So sweet crude meaning it comes out clear, and there's very, very, very little refining that has to take place to get it to where they need it. These are some of the areas that we're in North Dakota. Stanley, Minot, Williston. You can't see some of the others on here, which are, Watford City, Dickinson, Newtown. Those are some of the areas that we're in. This is kind of an interesting article as to what has happened over the past couple of years with North Dakota becoming as big as it has. The U.S. surges past Saudis to become world's top oil supplier. Not only that, but we have also, there's another article from Wall Street Journal, I believe, that announces that we are the #1 energy producer in the world now over Russia and Saudi Arabia. So it's kind of nice to be a part of that and be a part of what's going on. So these are just some of the charts here that are showing some of the trends of what's been happening and who's growing and where people have been and what's going on with them. So you see here in 2013, the U.S. is on pace to top Russia in 2013 as the top oil producer. We have surpassed Saudi Arabia already. Well, there's the Wall Street Journal. So population and growth, North Dakota is the fastest growing state from July 2011 to 2012. And that's just simply due to the region that we're in here in the oil patch, or what they call the Bakken region. Population is expected to climb 50% over the next 20 years in North Dakota's oil-producing regions. This number is changing, constantly. The growth and expansion here is absolutely crazy. I'm here right now, middle of winter. Took an extra 4 hours to drive here from where I was, a little bit longer than expected, but coming through the weather. But it's been pleasant today, 47 degrees. It's nice, balmy weather, they call it here. So, Bakken, what is the Bakken? This is a little description here of what the rock layers are, what the Bakken is. Rock layer is 10,000 feet below the surface. The Bakken layer is named after Henry Bakken in 1953. It occupies over 200,000 square miles, and in 2008, rock fracturing was introduced, and that's what fracking is. And there's a difference between two different types. There's two different types of fracking that are going on out there. There's fracking for natural gas, which is about 100 feet below the surface. Then there's also fracking for oil, which is 10,000 feet below the surface, or 2 miles. So they go down 2 miles, they go out from there 90 degrees, another mile or two, and they can hit a lapel pin if they want to. And that's a quote from Harold Hamm, who's the owner of Continental Resources. The perfection to what they're doing, the accuracy to what they're doing is very, very, very precise these days with the new technology and what they've been able to do with it. The oil boom. Companies are lining up to drill after survey shows that North Dakota gas fields are far bigger than believed. And this is something that's new as well. This is when they found, back in May last year, is about when they found the second layer of oil. And about a month and a half after that, they found the third layer. The first layer, they were saying, is going to make us one of the largest oil producers in the world. They were feeling like that find originally was going to put us atop of everybody else. Then they found the second layer, the Three Forks layer, and that layer alone, they believe, is twice as big as the first layer that they found, the Bakken layer. Then they find another mile past that, the Williston Basin. And they believe that one to be 2 times the size of both of the other 2 layers combined. So if there's ever a problem with fracking and they come in and try and shut that down for some reason, there's 2 other layers of oil that are would be traditional type of wells for getting the oil out. So just like sucking it through a straight straw rather than fracking or anything else. So, the controversy that over fracking has typically been over the natural gas, not anything else. And for seepage or anything like that to come up from fracking, it'd have to travel 2 miles to the surface before it got here, and through all the soil and everything that it would take to get through that. So, one company alone, this is in Montana, has drilled 41,000 wells since 1952. And another company just recently announced that it will drill 40,000 wells on its own by 2025. And I just met with an oil company today that they were extremely giddy today about 2,500 new leases that they just landed a little bit north of Stanley. So their activity is ongoing and constantly changing here. And opportunity is just growing and growing and growing. Still have the job boom. There's over 18,000 unfilled jobs currently in the area. You can get a job at Taco John's starting hours or $15 an hour. McDonald's $20 an hour with a $500 signing bonus and full benefits. I talked to a builder today that needs insulators, and I know that he pays extraordinarily well to people that are willing to do that and be up here working as hard as they can to get as much as they can done. And part of it is simply just due to the demand of housing that is here, and I'll go over that in a second. But North Dakota's labor market might be the best in America's. 99.43 of the labor force in the Bakken Shale area is working. They did a survey recently of the 16,000 people in Williston alone. There's only, out of 16,000 people, there's only 260 people that are not working. And they simply say that if you're in North Dakota and you're unemployed, it's because you're unemployable. Oil field workers, their average income wage they saw last year is about $112,000. Williston alone produced 14,000 new jobs between 2010 and 2012. These are some of a little bit old statistics, and it's just they're having a hard time keeping up with what's been created since then. Housing boom. We can go from man camps, or some would call it Afghani type of living conditions, where they build these temporary housing units and just you get a 10 by 10 room and put as many people in there as you possibly can. Companies are paying about $4,000 to $8,000 a month for one of these trailers right here for two guys to live in. We do permanent housing. In our permanent housing, we build 3 and 4 bedroom twin homes typically. We do 4plexes. We have some 12plexes. We are dabbling in a little commercial potentially this year that we're starting to bring online now, which is part of why I'm up here. We're also looking at doing some more 4plexes and things like that. So there's plenty of opportunity for different types of units if you're interested in some of the different opportunities that are here. And taking advantage of these through your IRA would be one of the best investments that you could possibly put in one of your IRAs. So there's traditional financing that we do offer. I know we haven't talked at all about the traditional financing, but typical loan on a $244,000, 25% down, you're going to be cash flowing at about $1,600 a month. Your cash on cash return on that's about 23.6%. That's based on 25% down. It does change with an IRA purchase. $244 with $3,000 a month of rental income, 40% down, you're 97.6. Plus some of the other fees that Jason showed you there, it ends up coming in at around $106,000, I believe. With that total out of pocket, you're still cash flowing about $1,500 into your retirement account every month in cash flow. So it's not too bad of a deal. The opportunity is ripe and ready for you guys to take advantage of. We also like to tell people that if you were to do a mortgage term on this and take all the money that you got back from this cash flow and put it back towards the loan, you could easily have this loan paid off in about 5.5 to 6 years. Stanley opportunity. We do bus tours up here every month. We're probably going to start doing them twice a month, just depending on demand and what we can handle. But Stanley is where we have a lot of these properties that are available now. You can kind of see on this map, it's right there above the N in North Dakota. The heart of everything that began up here, they say, is Williston, but truly it's on the outskirts of there. It was just the biggest city at the time that could handle some expansion and growth was Williston. So others have adapted. Stanley started at about 900 people as far as population went, and in since basically 2008, we're pushing the numbers of 75 to 8,000 people there. So it is growing quite rapidly. These are some of the units that we have under construction. They're much further along than this in the Stanley development. But this is kind of shows you that they are stick built and that they are finished nicely. And I don't know if you can see it in this picture, but right behind there's a well, right behind that twin home there. These are some of the interior finishes that you'll see. They are fully rent ready, which means they come with refrigerator, washer, dryer, all the appliances, blinds. Everything's there for someone to just come in, move in. And we do have furniture packages available as well for people for companies that may need those. So we do have that available also. We can discuss that later on. Anyway, some of the pictures of the insides of the units. You can see they're nicely finished. They are all brand new construction. And it's a little nicer than the trailer and the man camps that they can live in. So some of the other units that we have in Williston, these are some of the other units that we have that we can show you on the bus tour and talk about at that time. But here's an opportunity to come out on a bus tour, visit us, so we can show you how to better leverage your retirement money and work with Lamar, who has been fantastic to work with, and Jason. I think we've created a pretty streamlined system to get everything taken care of for the clients at this time. So North Dakota was a little bit of a challenge in the beginning, but I think we've got most things. Most of the bugs are worked out, and we are moving along quite well at this time to have everything happen very, very smoothly with all these transactions. And I appreciate the hard work that Lamar and Jason have put into that to help out with streamlining that for us. So little picture of one of our bus tours at the Stanley Drugstore. Everybody's enjoying a Whirla Whip. And anyway, we'd love to see you guys out. We'd love to have you be a part of this and really take advantage of the opportunity of building and growing your retirement fund. Please give us a call, contact us. My numbers are up top there. My cell phone number's there. I don't know if you guys could take a screenshot of these, and Lamar's and Jason's contact information. C-Wing can get all of this information over to you. C-Wing, we so appreciate everything you do and the hard work that you put into everything and the energy that you put into stuff. So we truly do appreciate it, guys. And C-Wing, we thank you very much for all that you do. Let me bring you back online here real quick. And you can add what you need to. And again, Lamar and Jason, thank you for joining us and being a part of this.
Thank you, Tyler. This is C-Wing. Thank you so much, and all of you have we work great as a team. This is my dream team of advisors, and really it was a pleasure to work with all of you for the past 2 years, working together to help our investors to achieve their financial freedom goals. And I'm very, very blessed to be part of this team. We're all here to help every one of you, and thank you for being on this webinar. And it have taken longer than 1 hour than we anticipated, but we have to put all the topics and information together, and it was not easy to get everybody together. So thank you for all my team to making this great presentation, and I look forward to helping all of you, my investors, my members, to achieve your goals and help you to get what you deserve in your financial future. Thank you so much, Tyler Watts and
You're welcome.
Jason Zook and Lamar Baxter. Thank you so much. Good evening, and take care. Good evening, and talk to you guys soon. Thank you so much. Have a good evening.
All right. Goodbye.